Hello and welcome back to the FT. We've just heard from Janet Yellen, the Fed chair, in her biannual testimony to Congress. Obviously, given the market turmoil of the last few weeks, it was a particularly important juncture, and it's been greeted with one of the calmest days of trading in a while. With me now to discuss this is our US managing editor, Gillian Tett. Gillian, thanks for joining me today. Let's start. Could I ask, did she manage to get through this, through her testimony without managing to surprise you?
Well, here's the amazing thing. The last couple of weeks have been crazy in the market, incredible volatility, triple-digit movements in the US markets. And before today's announcement, there certainly was anxiety inside the Fed that this could actually unleash more turmoil. The Fed actually changed the way it released the data into journalists to try and calm down the markets and give people plenty of time to digest this. But in the event, it was indeed a very calm reaction. That's partly because in some ways it was almost a content-free speech. She didn't give a lot of new information about how she sees the economy, but also because her message was very finely judged. They're watching carefully, but they're certainly not panicking.
Right. Now, let's talk about negative interest rates, which has been the particular scare of the last couple of weeks since the Bank of Japan surprised everyone by moving to a negative rate. Should we be taking the notion very seriously? What did you think of what Janet had to say on that subject?
Well, Janet Yellen was very keen to indicate that the Fed isn't actually changing course yet. It's leaving its options open. It's trying to stress that it's going to be data dependent. Although frankly it's a bit strange, it's trying to be both data dependent and time dependent, indicates it knows exactly what's going to happen. But leaving that aside, the markets are very worried about negative rates because it's not just to do with Japan. It's also because people are realizing that that may be where Europe and the US are heading. JP Morgan has come out with this hotly discussed survey suggesting, or piece of analysis suggesting that the Eurozone could see rates fall as low as 4.5% minus territory, looking at the lower bound and things. The US could also see potentially lower rates, it is suggesting. Fed certainly isn't there yet, but it's very striking. I was at a conference earlier this week with a number of large asset managers, and when they asked people to vote about whether the Fed would have to cut later this year or would actually raise again, almost 2/3 of the audience thought that they were going to cut.
And that's all the more intriguing because she was asked very directly, and she came as close to saying no as somebody in her position ever could. When she was asked whether she would consider cutting rates, she said she obviously couldn't see the circumstances where that would happen. So we still have that big disjunction between the market and the Fed at this point. Where do you see their most likely trajectory at this point?
Well, I mean, as you know, John, we've had a situation where the Fed basically came out at the end of last year and said it indicated expected 4 rate rises this year. The markets are currently saying 0. Somebody has going to have to change their mind. My best guess is that there's probably a good case for the Fed to sit on its hands for most of this year. I think to cut would be quite humbling, if not humiliating. But, events are moving quite fast. And in the global economy, there's not just fear, there's fear of fear developing right now. I mean, John, it's good old reflexivity, as George Soros says. I mean, but how do you see it, John? Do you expect to see rates being cut this year?
I can imagine it. I can only imagine it happening when we have moved into a situation that really begins to look seriously like 07, 08, which so far this is not 07, 08. There are various other market incidents I could talk about that are very similar to this, but it's still very alarmist to say that we're plainly on that course yet. The only way we get there is if we start calling into question the solvency of very large banks, as we did back in the era of Lehman. If you see really unambiguous slowdowns and move into recession, so I can imagine that. It's not at all my base case scenario. I would agree with Janet Yellen that's unlikely. I suppose if we come to one final question though, she's got to keep the balance right. How important do you think she should be regarding the attitude of the market at the moment? As we just said, George Soros has made the point, markets can create their own reality. She is doing quite a good job of not being scared by the markets. Is that the right approach?
frankly, she's doing about the best she possibly could, because when you're faced with what John Authers called reflexivity, basically fear feeding on fear, any indication that you're worried is going to just make the situation much worse. But equally, any indication that you're complacent and ignoring these problems will signal that you're out of touch. So she's trying to indicate she's watching, but not panicking. That's the kind of key mantra message right now. Let's hope it works.
Let's hope that indeed. Thank you very much, Gillian. So far, I think we're both in agreement. It's gone about as well as it could have done. She's played a very balanced, very difficult balancing act very well so far. Perhaps one final note of caution, that's what we said after the epic decision in December to raise rates. That was initially received very calmly. The era of calm didn't last very long.